Most investors use actively managed funds. In other words, they pay a fund manager to buy and sell the right stocks at the right time. But how well do active funds actually perform? S&P Dow Jones Indices keeps a running scorecard called SPIVA.
SPIVA stands for S&P Index versus Active. It's a study that we've done for the last 15 years in the US and that have expanded globally. The point of SPIVA is to compare the returns of actively managed portfolios to indexes that are appropriate for their style of management. So for example, we compare large cap US funds to the S&P 500, small cap funds to the S&P small cap 600 and so forth. So it's a way of understanding whether active managers are adding value relative to a good passive alternative or the best passive alternative for their style of management. What we find consistently with SPIVA, both in the US and internationally as we've expanded it, is the answer to that question is that they don't.
Worryingly for investors, SPIVA shows that most fund managers underperform for most of the time. What's more, even those funds that do outperform rarely do so for long.
We look back, say, 5 years and say, let's identify all the large cap equity managers who were above average 5 years ago. And then ask the question, of those who were above average 5 years ago, how many were above average 4 years ago, 3 years, 2 years, 1 year, and so forth? Now, the probability of flipping a coin and getting 4 heads in a row is 6.25%. So if in fact there were skill in that database of above average managers from 5 years ago, you would expect that more than 6.25% of them would be above average in every subsequent year. And it's not. Typically the result is in the 4 to 5% range.
So, are there any signs that active fund performance is improving? Well, in recent years, the answer is a definite no. In fact, performance appears to be getting worse. The reason for that may have something to do with the so-called paradox of skill.
In any human activity, success is partly a factor of skill and partly a factor of luck. The paradox of skill says that as the absolute level of skill goes up over time, the importance of luck to the result is more important. And so for example, in the investment context, what that says is, and I could testify from my own experience, the average investment manager today is far more skillful than he was 30 years ago. He's better informed, he's better educated, our knowledge of financial theory has improved, therefore the average level of theoretic knowledge has improved. He has access to big data and analytics, et cetera, et cetera, et cetera. All of that means the average manager is much better today than he was 30 years ago. Unfortunately, from the client's standpoint, it doesn't matter because the average manager is competing not against somebody from 30 years ago, he's competing against his contemporary today who's just as skillful as he is. Hence the relative importance of luck rather than skill.
So it's not that active fund managers are unskilled, in fact quite the opposite. There are also too many of them all competing with one another. The lesson from SPIVA then is that all, or at least most of your portfolio should be passively managed.